You know Palantir, the data brain behind many high-profile top-secret government contracts. And you may have heard of Anduril, the defense tech powerhouse. They've changed the game in data analytics for the military, and their valuations prove it. But what if I told you there's a third company building the same kind of data-driven empire, not for the battlefield, but for the backbone of our economy? Meet Samsara, the software-hardware data intelligence company that powers everything from logistics fleets to construction sites. Like Palantir and Anduril, Samsara's mission is to turn massive amounts of real-world data into powerful decisions. The stock has been volatile, but as it marches towards profitability with over $1.5 billion in revenue, the question is this the next big tech stock to surge? Stick around because we're going to deep dive in the data to find out. To really understand Samsara, we need to understand what they do. To simplify, there are two steps. First, Samsara sells sensors and cameras to install on things, like trucks and equipment. These sensors collect lots of data, 14 trillion data points last year, on key performance indicators like engine health, vehicle location, driver behavior, amongst tons of other things. Then second, all this data gets sent to Samsara Cloud's AI data analytics platform to analyze and then recommend real actions to save costs, drive efficiency, or promote safety, as you can see in the screen now, and see some of the recent packages that their data has enabled. At initial glance, I dismissed Samsara as assumed most of their customers are large delivery companies like FedEx or Old Dominion. As you can see here, the questions that their data can answer are things like, what assets need maintenance and repair? Or, which should we transition to electric? What makes Samsara so special is the physical operations they can support is over 40% of global GDP. Hence, why them and Palantir are the only two companies with $1.5 billion in annual recurring revenue, 30% year-over-year revenue growth, and last trailing 12 months of positive free cash flow. This is a necessary innovation with a tangible return on investment with real cost savings. Looking at their end customers, and my fear that Samsara's growth is capped with only supporting transport companies is quickly dismissed, as only 19% of their annualized recurring revenue is transportation. To summarize, Samsara collects data to send to its AI cloud, which then analyzes and provides actionable recommendations, and it serves a massive customer base beyond just truck drivers. There are very few companies that have this software-hardware integration, and even fewer that have this data analytics, which puts Samsara up there with Anduril and Palantir. But instead of for defense tech, it's really focused on industrial operations. What excites me most is this can further be accelerated by their flywheel of the more customers they collect data from, the more products they can create, which then attracts more customers for this virtuous cycle, and the proof is in the numbers. Customer count has doubled in the past 3 years, data points has tripled, and new products released has doubled. Overall, from a product offering and total addressable market, Samsara has to be the most exciting company we've covered for us innovation nerds. But let's get a look at their financials. First thing to know about Samsara is this high-growth company is not GAAP profitable, driven by their stock-based compensation. However, similar to many high-growth tech companies, we can see that GAAP operating loss is narrowing with the leverage they gain from surge in revenue. I'm not worried about this, since their operating loss is narrowing, and as you can see, they're now generating positive free cash flow. Also, as you can see in this chart, when removing stock-based compensation, their operating margin in fiscal year 2025 turned a positive 9%. In the first quarter of this year, fiscal year 2026 is accelerating with a 14% non-GAAP operating margin. Financials have a path to profitability, with the key financial metric I'm going to be paying attention to is their growth in annualized recurring revenue. Samsara in the last year has grown their annualized recurring revenue by 31% year over year to over $1.5 billion, and they've consistently grown it despite different macroeconomic events since their IPO in 2021. With their flywheel effect and the AI industrial automation tailwind, most analysts believe that this annualized recurring revenue will continue to grow greater than 20% year over year over at least the next 5 years. Incredible growth. Samsara's product offerings will be a beneficiary of the AI next stage tailwind, even though their journey began before ChatGPT was known. They also have a path of profitability driven by amazing revenue growth. Initial glance seems like a solid company, so the question is, will we be adding to our public portfolio? Before we share our thesis, please read the disclaimer in the notes below. We're not financial advisors, and anything we say should not be construed as financial advice, nor a formal recommendation. Also, if you love deep dives on innovative long-term focused companies like Samsara, please help us out and click subscribe. Now on to our thesis. For Samsara, the valuation has been the variable making me hesitant. On an absolute basis, they are trading at around a 15 price to sales, which is the same valuation back in October 23 when the stock was at $23 versus now it's around $30, $35. However, they have limited price to sale history on Samsara. So to really evaluate, I'm going to look for support. I'm going to evaluate on other similar fast-growing software companies like Datadog. To get a gut feel, I took a look at Datadog's price to sale back during the most recent tech sell-off and found that in March 2023, at around a 12 price to sale, the stock started an upward trend, and this is also seen in March 2025. Very limited data. Also took a look at high-growth software company Snowflake and also saw they had support around a 12 price to sale. If we were to add Samsara to our public portfolio, 3 key watchouts would be, first, keeping an eye to see if they can continue bringing new products for customers to subscribe to. This is what Palantir and Anduril do so well, which is harness all this increasing data they have to drive new capabilities. This is the ultimate litmus test for me as a precursor to continued revenue growth. And new products means existing customers may spend more and also continue attracting new customers. Second, this is a high-growth tech company, so need to see annualized recurring revenue continue to be greater than 20% year over year, with increasing free cash flow and a path to GAAP profitability in the next 2 years. Until then, quarter over quarter needs to see narrowing losses. Third, the valuation for Samsara will be key. This product is amazing and customers want it. However, not all companies can be like Palantir and be trading at a greater than 100 price to sales for a long period of time. Snowflake was around this at IPO, and during the bear market period, it sold off big time. Eventually, this bullish euphoria will stop, and companies need to be trained at a reasonable valuation. So in evaluating Samsara, the first criteria I'm looking at is Samsara's leadership. They are founder-led with a phenomenal CEO in Sanjit Biswas, who, like Nubank's David Veliz, epitomizes innovation and long-term focus. He previously sold his prior startup, Meraki, to Cisco, and he is joined by many of his former employees at Meraki in leadership positions at Samsara. Phenomenal culture, so very strong for leadership. Second criteria is valuation. I have this as a week. It is trading at a 15 price to sale, which is high compared to Datadog Snowflake's prior support at a 12 price to sale. Would ideally like to see it get down to price sale of 8 or 9 to really de-risk a little bit more, since 12 price to sale isn't really that great value compared with the market. Third criteria, revenue growth and profit growth. So I have this as strong, as the annualized recurring revenue grew 30+% year over year, consistently has been growing with a solid flywheel effect. And I believe this can continue growing 20+% every year for the next 5 years. Also, they're getting very close to profitable on a GAAP basis, which will be a huge plus. Fourth check is large total addressable market. And I have this as very strong. They have that $137 billion total addressable market, supporting 40% of global GDP and can support any industrial operations. Last point is long-term tailwinds, which is AI-driven automation. Palantir, NVIDIA, Anduril, so many companies have thrived in this applied data tailwind. And this one will have a lot of spend, as it's very, very useful as an application of AI. So I also have this as a very strong. So overall, with that said, I do love Samsara, and I think their product, their revenue, their growth, their leadership, it's all phenomenal. But I just can't get over its valuation. So I want to hold off on add-in until it's at least at 12 price of sale, which means its stock price of $28. Currently is trading between 33 to 35. With this high valuation multiple, and with it not being profitable, Samsara is a stock that if it doesn't continuously beat and raise earnings, introduce new products, really perform the perfection, the stock can get pummeled. Even though I believe this stock will be worth more in the long term, I want to allocate with my limited capital for our public portfolio at the right time, just to have a proper risk-adjusted price. Dad, what do you think? Can you walk through your technicals and kind of what are your thoughts on if we should add Samsara to our public portfolio? For sure, I want to add it to our watch list.
Okay, thanks, Scott, for that excellent presentation. Yes, looking at Samsara, the symbol IoT, and looking at the Bollinger Bands, they're a little more volatile right now because the bands are spread out more. And I would say that the Bollinger Bands are negative to neutral because it's on the lower, between the lower band and the middle band. So that's my take on the Bollinger Band. It's negative to neutral. For the moving averages, the 50-day is below the 200-day, which is bearish, and the 200-day is negative, and the price is below both. So that's negative. Okay, looking at my my valuation, the PEG ratio is not applicable because there's no PEG ratio. So that's a negative. The earnings history is positive. It's 4 out of the last 4 are beats. So that's positive. The profit margin is negative 9%, which is obviously a negative. The debt to equity is 0, which is a positive because there's no debt. And the analyst's opinion, there's, let me look at my analysts I follow. There's 1 strong sell, 4 holds, a buy, and then a strong buy. So that's neutral to positive for the analyst's opinion. And then again, the moving average was negative because, as I said, the 50 is below the 200, and the 200 is sloping negative, and the price is below both of them. So that's negative. The RSI is negative to neutral. Bollinger Bands are negative to neutral as well. And looking at the long-term tailwinds, on the positive side, the recurring revenue is above 20%, which is very good. But the stock-based compensation is high. Stock-based compensation is high, and then the price-to-sale ratio is high. It's greater than 12, which is the parameter that Scott was looking at as far as the 12 for Datadog and Snowflake. And the earnings are coming out September 4th, which is very soon. So I don't really want to buy when the earnings are coming out unless you're very an aggressive type trader. So I wouldn't really want to buy right now. And then the MACD, which I look at, is neutral. The on-balance volume is neutral as well, which is 2 new technicals I look at. But basically, overall, I'm a negative to neutral because of the things I discussed.
Thanks, Dad. So, we will not be adding Samsara to our public portfolio right now. This is an example of a phenomenal company, but a company like Palantir has had its stock run up ahead of its intrinsic volume. To build our public portfolio to be a market beater, we need to avoid the 50% sell-offs, as it takes 100% gain from there just to break even. Even though Samsara, for long term, we believe will outperform, we will want to wait until it de-risks a little bit, especially right now in the macroeconomic environments with tightening consultant budgets, tightening cybersecurity spend. This seems to be one that might have some rough guidance. But from a valuation perspective, if it can get to closer to the 12 price of sales, that would be $28 a share, where we'd want our first entry. Thank you for watching. To help us out, please click subscribe and like or comment as we aim to release regular deep dives about innovative, long-term focused companies.